Today we're going to have a look at a time-tested strategy, see whether we can leverage the bejesus out of it, and you will find out whether you already are a trader or a speculator or still have a way to go. Stay with me. Welcome, ladies and gentlemen. Welcome, fellow traders, speculators, investors, and students of financial markets. Today, I have a good one for you. I really like that because these are a lot of questions I get from people who are new to the market and want to invest their money and have this specific, okay, how do I do it? Can I work with leverage? Can I not? Can I increase my profits while doing that? Or is that madness doing it? So I thought, okay, how do I approach this topic the best? I start with a time-tested strategy you've all probably heard of. You can test it yourself, easy to do with an Excel sheet in TradingView, and then we see what happens when we apply leverage to it, because the strategy is actually really good strategy. If you don't want to be too busy in the markets, that's what you're going to use. So, how did I call this little presentation today? I call it the leverage trap. More return or more ruin? Yeah. Who am I? Thorsten Roland Wegener. I used to be a market maker, chief trader, head of trading, head of the derivatives business. I started as a humble trainee in 1995, and I finished my career as a partner at Bear Stearns when Bear Stearns unfortunately bought the big one. If you're interested in the whole story, I linked the video. So, what are we going to do today? We start with a couple of points. I explain the strategy to you if you haven't heard of it. Then we go into the scorecard. We look at the timing, market timing versus buy and hold. We always need a reference point to do that. The temptation is the leverage part. Obviously, that's the interesting bit. Then we have a brief look at the Kelly criterion, which is a mathematical concept, which is time-proven, tested. All the winners of various trading challenges work with it. Hedge funds work with it. The industry works with it. Why? Well, because it works. It's about the growth of money. And then we have, I chose the charts wisely, fantasy versus reality, to give us all a proper frame, what we're going to do with it. So, simple strategy. You've heard of it. We are invested in the S&P 500 when the market is trading above the 200-day moving average. That's it. That's all of it. When the market crosses below the 200-day moving average, we take the next day after that happened, our money off the table and put it into a money market fund. So it's safe there, short term, 3 months. And when the market climbs above the 200-day moving average again, next day we go into the market again and stay invested until we drop below the 200-day moving average. That's the whole strategy, right? So, how did that look in the past? I have 50 years of data here for you. And what you can see is if you would have invested 50 years ago 100 grand, you would have made a lot of money. If you would have invested in the S&P and the buy and hold, you would have made 7.3 million out of it. If you would have invested in the strategy where we are just staying invested when the market is trading above the 200-day moving average, you would have come out with 5.3 million US dollars. All right, there's a difference in it, and the market and the lines are actually moving very close together. Additionally, inflation. When I started this 50 years ago, you could actually buy a house for 50K. So yes, inflation is biting your purchasing power away. However, you would have made a good coin by following either the buy and hold strategy or the 200-day moving average strategy on the S&P. What I have in here are the two big ones, the 2000 recession and the 2008 recession we have in here. That's when the market took the big downturns in absolute terms. And that is already very interesting because you can see the buy and hold would have at a maximum given you a drawdown of 57%. If you look for the whole 50 years, you would have still made money, no problem. But you would have had a drawdown in the meantime of 57% for the buy and hold. On the 200-day moving average strategy, 24 or roughly 25% as a downturn. So there is a huge difference. Let's have a look at that on the scorecard. How to analyze it. We want to have as much data to observe what has really happened. So the annual returns, even there was a 2 million difference in the previous slide, shows you, all right, What does that mean in annual compounded returns? So the strategy with a 200-day moving average gave you an 8%, and being invested in the market over these 50 years, just buy and hold, would have given you 9%. Volatility, that is the number by how much is the market pumping around your growth path you have built in there. Volatility is 12% for the 200-day moving average strategy, and 18%, roughly what the market is on average. You have the VIX is the measurement for this. It's on average at 19 and median 17, and this is 18 because we've just taken 50 years of data. And then what is interesting is the worst drawdown. The 200-day moving average strategy would have given you concern about your investments. You would have lost at one point in time, not lost, you would have had a drawdown of roughly 25%, while on the buy and hold strategy, there was quite a bit of a clincher, I would call it, with almost 60% drawdown. So when you see 60% of your invested capital suddenly not being on your balance sheet anymore, it's time to worry. It's really time to worry. However, markets apparently we're at this stage at the moment where we're now looking at the S&P at the 8,000. Markets only seem to go from bottom left to top right. Keep that in mind. Over the long run, returns land closely together in these two strategies. You already have seen the effect over 50 years, what that makes in real money. It's a big amount. However, on the yearly returns, it's marginal. But the trade-off is obviously you don't have, at least over these 50 years, this gut-wrenching drawdown, because this strategy, the moment you go below the 200-day moving average, takes you out of the market. What can it not do? If an overnight crash is happening, you're too slow. But it gives you, if the market is firing up to go into a huge downturn, it starts falling, and it starts falling a bit more, then you have a recovery, and then it starts falling more, and it gets you new lows in the scenario. And that's usually where the 200-day moving average kicks in and takes you out of the market, and you put your money into the money markets. And then the market, at least in these two examples, made a huge downturn. But you're not affected by that anymore. You've preserved the capital you have invested. Your losses or your drawdowns, let's call it what it is, are definitely smaller than you would have the investment in the buy and hold strategy. However, that comes at a cost. This is the final return in our example, roughly 2 million, and only fueled by this tiny percentage difference we have. So the temptation, and I promise you can find out whether you are a trader or speculator quite yet or not. If you're already a speculator or a trader, and you see something like this, there is a strategy that obviously works, it makes you money. We're not talking about how much money, double, triple, quadruple monthly returns of 200%. We're talking about a strategy which is tested and makes you money. So the first question then is, okay, there is the buy and hold, and there is this strategy. This strategy seems to have a far lower drawdown. Why don't I leverage the crap out of it? Good question. And that's the question a beginning trader, investor, or speculator has at the back of his mind most of the time. The other question is, we're not talking about that today, is if you test something and it shows the opposite of what you suspected, you always think, oh, could I go that short then? But these are the two questions which say, you're really thinking down the terms of how am I a speculator? So the truth, strategy is calmer than the market, so why not borrow? Double it up, triple it up, do whatever you might want to do. And here's the catch coming in. Borrowing multiplies the good days and the bad days. And we will see the effect of that on your final returns in this strategy. So what have I here in this slide? The red line shows you the drawdown episodes, and let's start with the axis first. At the bottom axis is the leverage. We start with zero leverage, go up to 1, 2, 3, 4, and the percentage, the annual return, is on the left scale. The blue is what you really got out of this strategy when you employed leverage. The slightly dotted blue line tells you what you should have gotten out of it by all means the calculations you make to say, yeah, I leverage it up. So why is there a difference in there? And the answer is volatility. What do I mean with that? Volatility eats performance because markets go up and go down. And we go on the next slide to explain in easy terms why actually volatility eats performance out of it. And we can see that the drawdowns, that's the red line at the top, are actually exploding the more leverage you are applying to it because you have more money in this market. You're doing it not with your own funds, you're doing it with borrowed money, which means the bad days hit you just as bad as the good days might benefit you. And as markets tend to go slowly up and down really fast, there is a little catch for you. Well, you can see here, that's what it means when I say volatility eats performance. You start with $100. You lose 50% of that, so you're down to $50. Now you win 50% back, and you're only at 75, right? So if we're going from the top, you lose 50%, you're there with half your money. If then you make 50% again, you're only at 75. So you have to make already 100% after the loss, after you only lost 50%. The more this wiggles around, which means volatility, the more difficult it is to actually come at these expected returns out we had on this slide. So the slightly dotted blue line is what you should expect, and what volatility does to your performance with different leverage factors is actually the dark blue line you can see in here. And that is fueled by the drawdowns in your performance like we had on this slide. Obviously, you've seen this slide before, but I had to bring it in anyway. It simply tells you, lose half, you must double to recover. If you lose 60%, you have to make 150%. And if you lose 75% of your money, you already have to make an increase of 300% just to recover what you've lost. This is the relationship volatility eats performance, which gives you the first inkling why leveraging the bejesus out of something might not be so beneficial, because the expectation is not, I make 7%, I leverage up twice, I'll make 14%, I leverage up 3 times, I make 21%. That's a naive look at it. This, when we take volatility into consideration, is actually what this leveraging would do to you. So unleveraged, you can't really go broke. We have seen that. The probability that the S&P 500 goes to zero after you invested is very, very small. It can fall by 85%. Yes, we've seen that already, but broke in the definition is, okay, I'm totally out. I have been wiped out. There's no money left. So let's go into leverage. Now ruin, because we are talking, how can I get ruin, simply means the drawdown when you are working with borrowed money until you can't recover. It's usually when the broker calls you and say, oh, Mr. Wegener, could I have some more cash because you're speculating with borrowed money and the market had a really bad day. If I can't cough up this additional cash, they're going to take me out of the market. That is the danger of leverage. Nothing new here, but that obviously has an impact, and the definition is now how much drawdown can I eat up and still stay in the game. It doesn't, I've mentioned that before, it doesn't help you, this strategy, with a 200-day moving average over with overnight crashes. 1987, the S&P took a dump of 21% overnight, closing on closing, and intraday it was down minus 28% in this infamous October 1987. So the question is then, how big should I bet? And there is the Kelly formula coming in. What's the Kelly formula? It's not a lecture here on Kelly today, but it gives you, it's a mathematical formula you can very easily fit, and I have a slide in that as well. You can have a look at that, which simply says, okay, what's the volatility of the product you're trading? What's the average return you're expecting? You can backtest that and say, okay, the S&P average return 7, 8, 9%, volatility 17, 18, 19%. And what's the risk-free rate? When you have this data, you can actually compute what gives you the maximum growth rate. So you would invest a percentage of your money, and you would have when the market is improving, you made money on your account, you would take the same percentage for a bigger amount of money, put that in. If you would lose money, your account goes down, but you would still work with the same percentage of your investment into one's trading strategy. If you use that, you're at the top of this little circle here. That means that is the optimum. If you would always follow that and you're not going to get wiped out in the market, you will have as much return as you mathematically possibly could get if your assumptions, and for the S&P we have very, very long data, are correct. So what does it tell us here? So this is the formula you have in here. F is what we're looking for, F star. That is the amount of money I should, or the factor I should put in my investment. Mu, the little number, is the average, what the long-term yearly return was. Then R is the risk-free rate, and sigma squared is the volatility squared, called variance, and then it gives you the answer you should employ to get the maximum bang for your investment buck. 3.8 leverage on this strategy. Ooh. And there's the trap. That was the title of the video. At the optimal size, your chance of ever losing half of your money is about 50%. So you go in, you have 100, you invest that money, market runs against you, boop, you're down to 50%. Then you bet the same amount again, and you lose again. You're down to 25. You lost again 50% of your investments. And so already say, yes, fine. As long as the statistics are right, and markets always go up from bottom left to top right. With these rates, the S&P has proven over the long term, it's fine. You'll still come out a hero if it's your own money. Nobody is taking you out of the market. If you do that with leverage, you have a problem. And that's the 3.8 we have here, which is dragging us down. What I've done here in this chart is actually, on the left scale, we have the, model chance of ever losing half of your percentage of your invested capital you have in this trade. And you can see here we have a half Kelly, which means we're not taking the leverage of, 3.8. We're taking half of that, and it would give me a chance of losing my money is going down to 12%. And on the top, I've cheated a little bit. I looked at the real historical data, and these are the worst drawdowns. So on the red line, these are the expectations when we put our usual Monte Carlo simulation in. That is what should happen if I use the average performance and the volatility and the risk-free rates, put it in. That is what should happen. And the what is it? It's a black line. The black dotted line shows us what really happened in the past. And there is already, something in there which tells you, yes, theory is one thing, practice is the other. And what happens at the leverage dots we have in here, we would experience a complete wipeout. So, better fraction of Kelly. Best of all is half Kelly cuts the chance of ever halving to about 12%. Quarter Kelly under 1%, because it's a curve. It's not linear. You've seen the curve, so that takes the risk down. If you want to improve your odds, think in Kelly terms and say, I can't really risk a full Kelly. I can't risk a half Kelly. What do I want to have to reduce my chances? Quarter Kelly cuts it down to under 1%. For these numbers, staying fully under leverage is already only about a third of Kelly. So the bottom line, run the strategy at just the money you have, no borrowing. If you must, cap it near 1.5 times of the amount you actually have available. The better way to earn more isn't borrowing, it's fewer whipsaws, lower volatility. That is why investors love their Sharpe ratio, because it tells you the risk-weighted return of an asset. If you lower volatility, that means you get more bang for your buck for the outcome you have in there. So what you want to have is a high Sharpe ratio. let's say the S&P is diddling around 1 in terms of Sharpe ratio, sometimes lower, or most of the times lower, sometimes a little bit higher, and investors out there or funds offering you Sharpe ratios above 2, 3, 4, 5, wow. That is awesome, but do a double check how they're calculating their Sharpe ratios, which data points they take. There's a lot of fiddling going on to give you the idea that nothing could ever happen. We see that at the moment with private equity funds, and yes, because there is no marketplace for them. They say the price is what it is, so they have low volatility. The returns they forecast are right into their books, and then the relationship between expected rewards and volatility suddenly looks fantastic until you're trying to sell out and you don't get a market. What was the latest example? We had private credit funds. So here is, for the curious, the math I put in here. You can pause the slide and you can do all the calculations yourself. You see it's not too much input, and sooner or later I'm going to make a full video about Kelly with more examples. But if that is teasing you that there is something like an optimum rate to growth in a portfolio, look it up on YouTube. There are a lot of, there might be a lot of fantastic videos out there about Kelly. So, and now I've cheated a little bit. I said, okay, if I want to model this whole thing and think, the 200-day moving average strategy is pretty cool and I don't mind leverage, I have training data. And in this example, I said, from 1990 to 2000, this is what it looks. The light gray is the S&P, the buy and hold strategy. The buy and hold without the 200-day moving average, then the strategy with the 200-day moving average is the dark blue line below, not leveraged, and then if I leverage 2 or 3 times, you have the blue line and the red line respectively. And then you look at this and think, what the hell? Just having the strategy, the 200-day moving average in this time period, always performed worse than even the highly leveraged 3 times strategy. And see where I come out here. Factor 10.9 versus the buy and hold in the S&P of 5.3, or the non-leveraged 200-day moving average strategy. So you put that in your training data, you tell Grok or Perplexity or Claude, test it for these 10 years, because now we're looking into the future. You would have had all these tools available in the year 2000, and then you would have said, that's my kind of strategy. I leverage it up. I mortgage the house. The red strategy is for me. And then what happened here? We are now in the time since 2000 to up till now, and the strategy stopped working. Why have I chosen these data points deliberately? Of course, we had the internet bubble there. And you see how this leverage both works way to the upside and to the downside. When the lines go sideways, that means you finally are in cash. Until you're not in cash, and you lost, especially after the internet bubble, a little bit more, till you had a 3 times leverage drawdown of 64%. So you would have had the margin call, and it would have completely taken you out. You have leveraged your amount 3 times up. Let's simply say you had $30,000. You bought for $100,000 this strategy, and then the market fell by 64%. Your equities wiped out and some. So why does it at the end still comes up at the highest level in this chart? Because you are still in money. Money market funds give you performance while you're not invested, and the market did what it did. It went from bottom left to top right. We have an unprecedented bull market for a very long time, and if you want to be invested for 50 years, it might work, absolutely. We have this performance here with this strategy. We are in the meantime in money markets earning some money as well. And then the leverage works for the good times and obviously also for the downside. We've seen that in the 2000 downturn and the 2008 downturn. But the drawdowns are gut-wrenching, and if you do not have the cash available, you will be taken out of the market. So if you want to sleep well, what are you going to do? You read the risk disclaimer. Obviously, that's not investment advice, what I'm giving you here. But if you want to sleep well, you have a look at the strategy. You have a sum of money. You don't want to do all the speculating, leveraging up, and developing new strategies. You say, fine, I go into the 200-day moving average, or I invest in a buy and hold strategy. I have massively bigger drawdowns, and my colleague Falk, he has developed a model which he calls the Sparplan Optimierer. Let me try to translate that. Optimizing the savings rate, which is even beating the 200-day moving average strategy and is beating the S&P as well. So a little plug, go to his, or check out on one of our videos. We have it here on this channel. Otherwise, if you're German, listen to that Sparplan Optimierer. That is what you find on the World Wide Web sphere. I hope you enjoyed that. If you liked it, share it with fellow traders, fellow colleagues, especially with the beginners in these markets to get an idea about leverage, what's going on. And as a final word, I want to say thank you very much for being my guest today. And I hope you found this a little bit entertaining and you can make the decision. Are you already a trader or a speculator? Have you thought, how can I leverage the bejesus out of it? Or are you the sensible type of person who said, I'm not going to do that? I hope you enjoyed this. Bye-bye.